back again. How are you doing today? Now, today I want us to look at something really different, something that is apparently bothering a lot of traders, and which something that is very important, very paramount when we are trading, that every trader needs when they are trading, what we can call the lot size. Now, when you come to the MT4 platform, like this MT4 platform, ours, this is how the MT4 platform looks like. Now, on the MT4 platform, before you trade, you need to know of specifically which contracts, how many contracts are you trading, because when we are literally trading forex, we trade it in in terms or in units, which we call lot sizes. The lot sizes are basically determine what exactly units, or how many units that you're exactly exchanging for the other currency. Because when you are literally trading forex, we trade it in currency pairs, which currency pairs consist of two basically currencies, the base and the quote. For you to determine how much or how many units of the base currency that you're exchanging for the quote currency, it's actually what we refer to as the lot size. On the MT4 platform, it's along this region where we place or where we put our lot size. Okay, the bigger the lot size, the bigger the risk, and the smaller the lot size, the smaller the risk. Now, when we are, it's the lot size that determines how many units of the base currency that you're exchanging for the current, or for the other, or for the quote currency. Now, the bigger the lot size, the bigger the risk, and the bigger the return. So when the lot size is relatively big, this technically means that you're expected to earn or lose big amounts of money. Okay, so when it comes to the lot size, we have different categories of different types of lot sizes. We have the standard, we have the mini, the micro, and the nano. So basically these are the types. So before you trade, let's see how important the lot size is when we are trading. Before you start trading, you need to know how much are you risking on a particular trade, because every day we don't plan to fail, but we fail to plan. So before you go to trading, you need always to first plan before you can start trading. Now, planning starts at the point when you start risking a certain amount of money that is planned. So before you start trading, it's always very paramount to know how much money that you're risking on every trade. Like, let's say for instance, now when it comes to this market, this pair is actually New Zealand dollar, US dollar, which is apparently a good setup for a good sell. For those of you that know how to trade moving averages, I released a video relating to the moving averages. Now, when you're looking at the moving averages, we will look at the moving averages. The signals are generated normally at the crossover points. The crossover points are basically a point of the point at which the two of these lines match, which we call the crossover point. And when the short moving average crosses the long moving average from above coming below, it relatively means that this market is expected to move in a sell position. So when it reaches to such a point, we're expected to sell this market. What we do, we start planning our trade. So now, these are the procedures that every trader has to take before you start trading. The first thing that you need to first know is to have a strategy. A strategy basically means that if point A is this, then point B should be this. So for instance, now, if the moving average is closing, when the short moving average crosses the long moving average from above coming down, that is A, then therefore B should be a sell. So this is basically what a strategy means. Having had a strategy, within a strategy or within a system is where we have a strategy. So our system tells us that when they cross, it's an entry point. So at the entry point, we actually start planning our trade. So we plant and we have put a demarcation specifically from the point where we're going to put our sell point. Then secondly, we demarcate the point where we put our stop loss. Normally, as these moving averages, or as these two moving averages are moving, when they cross each other, it means that now literally means that the point or the moving average that literally worked as a support is now going to turn into a resistance, meaning that the red moving average is now going to be above and the short one, this is going to be below. So this means that this point at the point of the crossover is basically where we're going to have our resistance. It can either, this time if it's a resistance, the next time it's going to be the support. And remember, for every entry of a particular trade, when we are putting our stop losses, we always put them either below the support or above the resistance. That is, if you're selling. For this case, we are selling. What we do, we put our stop loss above our crossover point, because it will literally mean that this point or this region or this crossover point is now going to work as our resistance. Then we put our stop loss above the resistance. Then this becomes our entry point. But the purpose of trading is basically for you to be profitable, is basically to minimize the losses and maximize the profit. Meaning that if we're risking a certain amount of money on this trade, we can literally aim for something big on this very trade. So if you're risking a few pips from this point, like I'll look at this at firstly the perspective of the pips, then we shall come to the dollar values as well. Now, when you're risking, let's say, the number of pips that we have here, let me measure them using this tool. This tool is called a crosshair. They are basically 5 pips, exactly 5 pips. The crossover is basically a tool that is used to measure the pips. So if we're risking 5 pips, then it will mean that our take profit is going to be, so when we risk 5 pips, we should aim for 10 pips, or what we call to a risk to reward ratio. So if this is 5, then we should aim for 10. So 10 pips, those are 10 pips. Then I can also demarcate my take profit. It means that this is where we're going to put our stop loss. A stop loss is basically an order that stops us from making more losses, and the take profit is a point where we expect it to make or to take our profits, provided when market reaches that level. Now, the next very important point is a point where we're going to be calculating our lot size, because we now know where we're exactly going to be putting our stop loss, our take profit, the pair that we are trading, the number of pips that we're risking as our stop loss, and the number of pips that we're risking as our take profit. Now, let's get to the point from where we can start doing our calculations to know the appropriate lot size to use in relation to New Zealand dollar, US dollar. What we do, we apply this formula. We apply our formula. We apply our formula. Now that is our formula. This is how the formula works. Now, for you to get the number of lot sizes to use, first you need to know your capital. Okay, you get the capital that you want, the capital that you're using. You multiply it by the risk per trade. The risk per trade can either be from 1% of your portfolio to 3% of your portfolio. So you can risk only between 1 to 3% of your total capital. So this works as our capital. Secondly, this works as the risk percentage, or the percentage risk per trade, because when you are planning, it's always important to know how much you risk per trade. Then the stop loss distance is basically the number of pips from the stop loss to the entry point where you are selling. Okay, where we are selling. And then lastly is what referred to as the pip value, or the pip value, or the value per pip. The value per pip, when we are installing our MT4 platform, it comes with the default values, which default values carry standard lot sizes of particular lot sizes, okay, of particular pairs and lot sizes of particular pairs. Now, by default, the values or the lot value that comes with our MT4 platform are basically those values of the standard lot size. So for each and every currency pair, it has gotten a standard pip value, which we should actually always have with you. This one, you always have it. This one, you have it. In other words, you know the capital, you know the risk per trade, you've calculated your stop loss distance. For our case, it's 5, and then you know the pip value. I created a list of pip values. Now let's go and look for New Zealand dollar, USD. Okay, so we come here. I have a list of those New Zealand dollar, US dollar. The standard lot, it's actually 10. Okay, so we are saying, where is our calculator? Calculator is here. Good, fantastic. Yes. So we have this. We are using a capital of $500. Our capital is of $500 times the risk per trade. We said that for you to trade, you should always risk between only supposed to risk between 1 to 3% of your portfolio. For this case, I'll take 2%. Now, let's first calculate the value up, and we know it. We pick our calculator. We say if we have $500 times 0.02, that is the 2% per trade, we get a 10. We get 10. So our 2% now that we are risking is going to be 10. So in other words, we're risking $10 on this trade. Then our value up is 10. We keep that, and then we come down, and our stop loss distance was basically 5 pips. We multiply it by the pip value that we said. It's basically a 10. So we get our 10. So we get the answer as 50. So you get our 10, which was the upper value that we got up here. We divide it by a 50, which gives us a 0.2. Now, 0.2 comes to be our lot size. Okay? So when you come here and put your 0.2, it means that here you will be risking the $10, okay? Because our formula tells us that you're risking 2% of basically the total portfolio of 500. So we are risking 10. 10 is our 2% of $500, okay? Which is our capital. So what we do, we basically come and put our lot size. When we put our lot size, when we try to adjust exactly to put the stop loss where you demarcated as to a point of your stop loss, you realize that you exactly risking $10. And then when you adjust exactly where you put your take profit, you exactly get $20 because you're risking 10. You're risking $10 to make $20. Okay? Now, this means that when you start selling, the fact being that today the markets are closed, it's a Saturday, we can't execute a trade. Now, when you execute a trade, when you put your trade here, a sell point, and you adjust the stop loss, it will exactly reach at this point. When it reaches this price, it will be like you're risking $10. And when you adjust your take profit, it will be literally take profit of $20. Now, this means that for every trade, if you have a calculated risk, okay, a calculated risk, just like entrepreneurs, entrepreneurs will always go for calculated risks. Now, when you go for such a trade with a calculated risk, meaning that at the end of the day or at the end of a prescribed period of time, you will have a positive statistical edge because you always make a smaller loss and always maximize your profits. Okay, that's basically the secret about trading. Always calculate your risk. The secret about trading is basically risk management and money management. The money management is basically calculating your lot size, and the risk management is basically using a risk reward ratio. By risk reward ratio, we're literally looking at a risk reward ratio, for example, 1 to 2 means that if you're risking less than $10, you should aim for the double of what you're risking, like what we've just done here. We've risked $10 to make $20, and so on and so forth. When you have a strip of these, risking something small and getting something big, it means that at the end of the day, you will have something that is positive. Okay, we have something positive. If you really still want to learn more about trading, please subscribe for more videos such that you can see all my videos that can help you. When you're stuck, you can always pick the contacts in this video and contact me for further studies, or if you want to be a professional trader. Thank you so much. Thank you for watching my videos. Have a good day. Bye bye. Thank you.